Okay, all are in. Farid, pass to you.
Okay, thank you so much, Caroline. Welcome, everybody. Good evening. My name is Faridq Ridzuan. I am the Vice President of the CFA Society of Malaysia. So, as I said earlier on, right, a huge welcome to everyone here today, and a big welcome also to our flagship panel talk, which we hold every year at the start of the year, to see how can we navigate the years ahead in the year ahead in the capital markets. Let me just, before I pass it on and introduce our esteemed panelists for today, why don't we just go through a brief recap of what happened to the KLCI and the Malaysian market in 2020. Yeah. So in 2020, the KLCI started the year at 1588 points and ended the year at 1627. Giving a total price return of about 2.4%. That sort of benign sort of number really doesn't speak justice to the actual volatility that happened over the year. Yeah? So from the start of the year, from the 1st of January of 2020, we saw the market go up to 1611 on the 3rd of January. Yeah. Before, of course, worries about the pandemic started to break out, and we saw a maximum drawdown of about 24% to 1219. And that happened on the 19th of March 2020. For those of you who started to buy on the 19th of March 2020, I salute you. But for the rest of us, we just hung on for the ride, where it rebounded by a massive 38% to 1684. Which marked the high of the year, and that was on the 11th of December 2020. So a lot of developments happened over that year, which brings a lot of questions to what will dominate the investment market, or the themes that will happen in 2021. And for that, that's why we have three very illustrious panelists today: Mr. Keat Seng, Mr. Xiang, and of course Mr. Khai Jhek, to walk us through their thoughts about what will happen in the year ahead. Yeah. So before I go into that, of course, let's launch the poll to really get a dipstick, to see what is everyone's expectations at the start of the year. Yeah, and of course before this presentation, and whether it will change after this panel talk. So we want to measure if there will be any changes in expectations. Yeah. So Caroline, do you mind if we just launch the poll?
Yep.
So there are three questions over here. All you guys have to do is just select what do you think best represents your expectations for the year. So we have three questions. Number one is really the investment theme that will most likely drive investment markets for 2021 for the Malaysian market. Next, we want to know what are your thoughts on which asset class will be the best performing in 2021. And of course, finally, we want to know for the audience, which sector do you think will perform the best in 2021? Yeah? And will that change at the end of this panel talk? So I'll give you a few moments to answer. Caroline, if you feel like we have enough responses, then let's have a look at the results of the poll and see whether.
Getting there. We're about close to 70% voted. So let's see about 75, 80, then we'll close.
All right.
Okay. So I'm just gonna end the vote. I'm gonna share the polling results. About 85% of you guys have voted. Yeah, share results. So you can see the results on your end.
Yep, I can see. Okay, so it's quite interesting. Yeah, so most of us on in the audience today think that COVID-19 will be the dominant investment theme for the year. EM equities will be the best asset class, and finally technology will continue its amazing run in 2020 to once again be the champion of 2021. Let's have a look whether this changes at the end of the talk. And now, let me just give you a brief introduction to the format, the format of how this panel session is going to be. What we are going to do is that we're going to let all the panelists deliver their piece for about 15 to 20 minutes each. And we will reserve the questions, all Q&A, to the end of the session. Yeah? So this is to ensure the smoothness of the presentation and so that we can all take something away from this talk. We aim to end around 7:30. And I really welcome everyone to put in your comments and questions at that link which is on the screen now. So can everyone just sort of load it up? Give everyone about 10 seconds. And most importantly, this webinar, it will be recorded and you can rewatch it again on our YouTube channels and other form of channels. Okay, so I hope everyone has already loaded up our Meet platform to post your questions. And now we can start off with the first panelist. And we're going to start off with a presentation on the regional and Malaysian economic outlook for 2021 by Mr. Woon Khai Jhek. So Mr. Khai Jhek is a senior economist at RAM Ratings, and he also looks at macroeconomic analysis and projections, and most importantly, he also is responsible for the production of the Bond Market Monthly. So he's very familiar with both the macroeconomic outlook as well as he can touch a little bit on bonds, and most importantly, of course, he is a CFA charter holder. So the floor is yours, Mr. Khai Jhek, and over to you. Thank you.
Okay, all right. Thank you, Farid. So good evening, everyone. Or maybe good evening, or maybe good evening, everyone. Sorry, depending on where you're coming from. So maybe it could be morning or afternoon. So I'll be starting off the series of presentation today with the general macroeconomic prospect and outlook for 2021. So I'll try to set a bit of a scene of how the overall economy is actually going to look like, and hopefully be useful as a foundation for my next two speakers to expand upon in their presentation. So the next slide, please. So the most buzzword that we use for 2020, at least among, I guess, economists, would be the word unprecedented, other than just the word COVID. But in a way, I think we can't help but just keep saying that it's unprecedented, because in a way, it is in fact something that's the recession that we actually face in 2020 is something that we can't really compare to the past two crises, such as maybe the global financial crisis as well as the Asian financial crisis to a certain extent. Firstly, a very big change that we've seen so far, at least for maybe in the ASEAN region, is that the geographical as well as the fragmentation of the global value chain or the global supply chain that was back maybe 10, 20 years wasn't as prevalent, and which is part of why we see such a sharp slowdown across the region in the beginning of 2020. Other than that, another, I guess, way that we can say is unprecedented is that in this sense, it's both a supply side crunch as well as a demand side pressure. Unlike in the past, where if you see a crisis, it's mostly a demand-led slowdown as well as a deceleration. So coming into 2021, I would think that I found a new word I would probably be overusing a lot as well, and that would be uneven, or in a more colloquial way, as I've written in the slides, that we are on for a very bumpy ride for 2021. So while we have seen some quite promising recovery in 2020, the second half of 2020, However, that is also actually very much subject to how the virus is actually controlled around the world as well as domestically in Malaysia. So as the country has actually gotten under control, we can see quite a steady sort of a recovery in most of the high frequency data, as you can see on the bottom three charts for the manufacturing PMI and some of the export volume indicators, as well as the physical spending that is tracked by the Google mobility indicators. But however, once we go over this transitory slump, the whole economy will actually need to put a whole lot more energy to get everything back up again. So it will be like a rinse and repeat kind of process moving forward, which I think, especially for Malaysia, audiences in Malaysia will actually know that we've recently been having to experience a tighter movement control order or motion control restrictions, as well as some, if you see in the news, there's been quite a lot of drastic movement control or restrictiveness in the European region. So if you reference both the IMF and World Bank, you would know that a recovery in the GDP growth for 2021 is fairly certain. However, both institutions do acknowledge that 2021 will remain a very challenging year, and to a certain extent, IMF's latest outlook report title does echo the fact that recovery will be fairly uneven or even bumpy, with its calling it a very long and difficult extent. So this highlights the challenges arising from the unevenness in the overall recovery trajectory that will likely remain a mainstay for throughout the whole of this year, and the overall economy will likely still remain below pre-pandemic trends. Next, so sorry, the next slide, please. So one of the key changes that will come, other than just COVID going into 2021, would be on the US side, we will be welcoming a new US president. So barring the recent riots or protests, the US is expected to actually welcome President Biden into White House next week. So given the numerous challenges that the country face domestically, we view this event as more of quite a rather limited near-term global impact, given that policy emphasis will likely actually remain largely lean towards more on the domestic side, while also fulfilling some of these President Biden's promises along his campaign trail during most of the first year of President Biden in his office. So if you will look into the more global perspective, the positive impact would also likely be more towards the global trade, even though it would likely not materialize as soon, or any changes will likely not be that immediate. So the positive impact towards global trade will likely be more towards the more stable nature of, I guess, President Biden, in the sense that we will not see any widespread or immediate reversion of previous trade barriers and tariffs set up by President Trump. Because based on what we gather, based on President Biden's policy stance along his campaign trail, is that China will likely remain a pressing issue. So any widespread reversion is not likely to happen. And the new administration will likely just capitalize on this opportunity to actually engage with their trade partners to actually resolve long-standing trade issues. So, but this time the policy benefits I mentioned before would be just that we would not see the ongoing knee-jerk policy reactions or the uncertainties arising from that tit-for-tat tariff rhetoric that we see under the previous Trump administration. So with this a bit more conventional, if not more measured approach to foreign politics and relation, the incoming President Biden is actually expected to lower uncertainties in the global trade policy direction next year. So it is a slight positive, you would have to say, albeit maybe not so soon, in maybe the first half or even the second half of this year. Next slide, please. So while a change in US administration hopefully would bring an end to the volatility in trade policies and relations between US and China, however, one of the, I guess, key global trend that would unlikely to stop would be the ongoing global supply chain realignment. So ASEAN specifically, Vietnam, Malaysia, and Philippines is seen as the biggest beneficiary from the E&E or semiconductor-focused dispute between US and China. So given that these three countries are actually relatively competitive in the region in the production of these products. So the recent COVID-19 pandemic has only served to actually accelerate this trend, as it exposes the risk of concentration of production within just China. So I think even without this, even before the COVID-19 pandemic, we've seen quite a big increase, or a somewhat notable increase in terms of exports of these countries towards the US. I think Vietnam have seen quite a notable increase across not just US, but also as well as China, and the same can be said for Philippines. Next, please. Another positive development for the ASEAN region to look out for going into 2021 would be the ratification process of the RCEP being the Regional Comprehensive Economic Partnership Agreement. So after an 8-long-year process, the RCEP negotiations have finally concluded back in November 2020 last year, and the agreement being signed then. So once ratified, actually the RCEP agreement, or the RCEP bloc, would actually form the world's largest trade bloc, covering about 30% of the global population and as well as global GDP, and also covers about 28% of the global trade. So the deal on its surface alone is actually much bigger than the CPTPP free trade agreement. It's another similar multilateral free trade agreement within the same region. So when this deal actually comes into effect, it will actually create quite a large common market and will actually help to boost trade within this region. However, one thing that remains uncertain is when this deal will come into effect in 2021, given that it will still need to be ratified by at least 6 ASEAN members as well as 3 non-ASEAN members before it can come into force. And the last we've checked, none of the ASEAN members have actually ratified it in the parliament so far yet. Next slide, please. So given the sheer scale and number of countries involved, maybe I'll just dive specifically into what's in it for Malaysia, since this might be most relevant to most of the audience today. So the main benefit for Malaysia will actually come from smoother trade facilitation rather than trade reduction, given that Malaysia already has existing bilateral or maybe multilateral free trade agreements from ASEAN with all the signatories to the RCEP agreement. So the consolidation as well as the simplification of the rules of origin under the same agreement could actually smoothen trade, as well as the trade of inputs and parts within this block, as all these components will actually be treated uniformly, and this will help facilitate the trade within all these member countries. So with all the members being a lot more connected along the value chain, this will in turn promote even more trade and help to boost the overall trade within this region as well as out of this block in the future. Next. So if we talk about coming back closer to home, if we dive in further from the ASEAN region, despite all the positive development in trade that could potentially happen next year for Malaysia going into 2021, the key determinant for Malaysia's economic prospect for Malaysia is still largely dependent on how well Malaysia as a whole is actually coping with the COVID-19 pandemic. So as briefly elaborated in my first few slides, Malaysia's recovery path is actually will also be on a fairly uneven path. So the recent targeted tightening of MCO actually will definitely put quite a large weight on the overall economic activity, given that it's much stricter compared to the CMCO or even RMCO that we are actually undergoing previously. So unfortunately, the states that are placed under the strictest MCO regime are mostly the key economic hubs of Malaysia, such as Selangor, KL, and Johor, which makes up quite a proportion of the overall economic output for Malaysia. The states that are under the strictest MCO actually constitute about 66% of the Malaysia's overall GDP, and so we will see quite a large, or at least more than half of the overall Malaysian output actually at risk of severe disruption. So this is also a large sharp reduction from the last few months, where economic output or GDP are mostly under the more relaxed CMCO or RMCO measures. I think if you look at the right-hand side chart, we can see that before the recent implementation of the MCO measures, more than half of the states are actually under the more relaxed RMCO, with certain areas that has higher case counts under the CMCO measures. So back then, the overall economic activity is relatively still rather robust. Next slide, please. So if you look into just a few of the charts, if we can use the historical data as any guidance, the tightening of MCO will actually bring back a more dual speed economy for Malaysia. So back then, when we faced in 2020, when the MCO measures were first launched in April, May, and so on, we can see that the non-essential manufacturing sectors actually saw the deepest decline. So compared to maybe the more essential manufacturing sectors, such as your gloves or even your healthcare or food and beverages kind of manufacturing. So based on our own capacity utilization estimates, the drop in productive rates among essential sectors is actually much milder at approximately 65% compared to just 25% for non-essential manufacturing. So we should, if this history serves as any guidance, we should expect this unevenness to also persist in this under this MCO 2.0. And I think the government has just recently released the list of sectors that's allowed to operate under MCO 2.0, and that list actually differs from the current classification that we're using now. Hence, we would need to further, I guess, look into the specific sectors that would benefit to a certain extent under MCO 2.0 on a relative basis. So another segment that will also take a hit would be the retail sector, as we can see from the drop in the physical spending activity proxied by the Google mobility data during the MCO 1.2, as well as the recent slight dip that we see during the recent CMCO period in October through November 2020. So the unevenness doesn't actually just stop from the sector-specific kind of performance. The pace of recovery in capacity utilization or productive capacity usage also differs as the sectors that have actually seen the sharpest drop also took the longest to actually recover back to what we have deemed as the normal rate, as you can see from the red line that we've seen on the first two charts on the top left. Other than that, if you look specifically into the labor market will also expected to take a big hit from the recent MCO, which is already experiencing a slow recovery to begin with. So things are not actually looking that good for the labor market. The proportion of working age population that is currently employed, which I typically use as a proxy for the overall consumption pool for Malaysia, remain well below the pre-pandemic level of 65.1. Currently, I think the latest data was for November, compared to 66.7 in January. And this is just slightly higher than its trough at 64.4% back in May. So with we also expect much of the job losses to actually come from tourism-related sectors. So another form of unevenness. So I think I've used the word unevenness a lot. The sector-specific weakness would also come true for job losses as well, given that I think tourism-related sector would actually be the most hard hit from any form of MCO measures. So we would expect the same to happen under MCO 2.0 as well. Next slide, please. So, however, one glimpse of positive hope that we can preliminarily gather from what we have seen or what has announced so far, or the SLPs that's been announced currently for MCO 2.0, would be that the MCO 2.0 might not actually cause as deep a contraction as the one we saw for MCO 1.0 back in March, April in 2020. So some of the, positive side or the more positive news that we can gather from whatever's been released so far is that the essential sectors that's allowed to operate covers a much wider scope of sectors compared to MCO 1.0, and it also covers specifically that those along the supply chain for those sectors that are deemed essential can also operate. So the the restrictiveness isn't as restrictive, but the relevant SOPs are still there. So some of the additional sectors that wasn't covered under MCO 1.0 will be like ceramics, iron and steels, and surprisingly hotels are also allowed to operate. As well as like some of your professional services, as well as the typical mom and pop kedai runjits. Another positive that we can see is also there is no explicit hard cap on the industrial operating capacity under MCO 2.0, compared to these explicit directives to actually reduce your operating capacity by at least 50% under MCO 1.0. This would actually free up a lot of productive capacity for manufacturing or the general industrial performance for under MCO 2.0. So I guess another slightly positive news was also that MCO 2.0 is not nationwide. So as mentioned under at the back, the previous few slide, only 66% of the overall Malaysian economic output is actually under the strictest MCO measure. So hopefully those that are under CMCO or RMCO measure would actually help to offset some of these, I guess, economic output losses that we will see over the next few months. However, I guess on the negative side, we still need to emphasize that the interstate traveling restriction is still quite a big impediment to business activities, and this will in turn lower the general business activity as well as overall economic output for Malaysia over the next few months. And while government has actually, I guess, put a lot of emphasis on ensuring that disruption to supply chain, domestic supply chain is actually to be kept at the very minimal, but we would believe that with all the restrictions in place as well, the roadblocks and all, any disruption will entirely be unavoidable under these circumstances, and this will actually weigh on the overall economic activities. And as such, we would definitely see some form of productivity as well as efficiency loss under all the MCO measures as well as SOPs that the firms have actually need to adhere to. So another, I guess I mentioned before this, retail sector will likely take the biggest hit as well, given the lower footfall as well as the shorter operating hours. So we will likely see some form of shortfall in consumption spending, especially on services that actually require face-to-face interactions. Next slide, please. So I guess some of the mitigating factors have been actually done by the government back in 2020 as well as under budget 2021. So hopefully this all these stimulus measures would actually help to alleviate some of the downside risks that would arise from the MCO 2.0. So if you look at the stimulus packages launched so far in 2020, around 42% of the allocations are actually aid for business continuation. So such as the wage subsidy programs, the grants, as well as loans for SMEs or micro enterprises. So this will actually help firms to stay afloat, and once they survive, they can actually take off once the restrictions are lifted. So other than that, there are also SMEs focused measures as well, as we all know that SMEs typically are the ones that are the most vulnerable under the MCO measures or under the general COVID environment compared to the bigger corporates, which has a larger cash flow pool or a lot more resilience to weather through the storm. I guess another key measures for the government to support the general economy would come from the income support measure, which had a big emphasis in the latest budget 2021. So of all the stimulus measures announced in budget 2021 speech that we've collated, about 82% are actually household focused. So this will actually aid to ensure that households actually stay afloat and continue to spend and hopefully maybe generate further multiplier effects throughout the overall economy. So with this, it will actually help support overall sales volume, and this will in turn also help businesses to actually generate more sales, and rather than just relying on the government to actually hand out grants or subsidies. So if you go on the monetary side, the low interest rate or the low global interest rate environment is expected to actually persist through the most of 2021. So for Malaysia specifically, OPR was actually reduced by 125 basis points in 2020, and we would expect interest rate to remain low throughout 2021 as well. Other than that, the US Federal Reserve has also during their last dot plot or their interest rate projection have actually indicated that there will be no interest rate hike at least until the end of 2023. So the accommodative as well as the I guess the ongoing liquidity boosting measures are actually expected to actually support the overall financial market for this year as well. So the favorable yield differential between maybe the US as well as the Malaysia will actually continue to help drive favorable foreign fund inflows as well as support the ongoing USD ringgit exchange rate throughout the most of 2021. Next. So one other way we can actually put all of this behind us and move along would be actually the vaccines. Vaccines have actually taken the headline for quite some time now, actually. And we feel that this could actually potentially be the silver bullet to the current crisis. However, timing-wise, we do not actually expect Malaysia to see the full benefits and immunization coverage desired to come in within 2021. We feel that the competition for procurement has been actually rather stiff, especially given the production bottlenecks, along with the limited supply / the excessive demand conditions that the overall vaccine production is actually facing currently. So this will actually limit the accessibility to across all the countries around the world. And this is also what we partly observe as well, where procurements currently actually heavily leans toward the high-income economies. So based on the procurement data, we were able to find some high-income nations such as the US, EU, UK, and Canada has actually already purchased enough dosage to actually vaccinate its population more than 2 times over. And so this, if you compare to just Malaysia, I think the last announcement was that we only have enough to cover 50% of the population, close to 50% of the population. And for Malaysia specifically, 39% of it will come from the government's agreement with Pfizer, while the remaining 10% will be under the COVAX facility, the COVID-19 Vaccine Global Access Facility organized by WHO. So timing-wise for Malaysia, 50%, while it's not reaching the, I guess the 70 to 80% needed for the herd immunity to actually take effect, timing-wise is also not as favorable given, like say for the Pfizer vaccine agreement, the bulk of the vaccine will actually be delivered only in the second half of 2020. So if you look into the numbers, I think about I think more than half actually, or about 80% are actually expected to be delivered in the second half of 2020. So most of it in the third or fourth quarter. And I guess the realization or the implementation will actually take time. So this will further delay some of the desired vaccination benefits to come in place in 2021. So we would continue to see some form of, I guess, physical distancing measure throughout the most of the second half of 2021 as well. And I guess the full benefit will likely only come in 2022. Next slide. So I guess this brings me to my last slide. So we generally expect Malaysia is expected to stage a recovery. So again, I'll emphasize 2021 will likely be a bumpy year, or it will still be a very uneven recovery for 2021. So, but this will 2021 will definitely be better compared to 2020, which we estimated at about minus 5.3% year-on-year for the overall GDP of Malaysia. However, 2021 will definitely not mark a return to normal, and GDP will likely still remain below the pre-pandemic projection in 2021, and growth trend will still be characterized by the general dual speed economy prospect, and the day-to-day life will still be we will still be seeing some form of restrictions and constraint on operating capacity on certain economic activities. So even with if the current NCO measures are lifted, if cases continue to rise, we might see a scale back or a deceleration in overall activities moving forward until the full vaccine immunization coverage comes into place. So in a way, businesses must actually be ready to weather the uneven and stop-start operating conditions, and I guess be ready whenever it comes. So we don't have to always wait for the, I guess, heads up from the government, which they would not be able to tell. I guess no one actually really know when's the next restriction will come in. So I guess the upside for 2021 or a positive surprise would, if the vaccine would actually be complete and the widespread completion of global distribution of the COVID-19 vaccine. So this will lift the overall economic activity for 2021. And I guess a downside surprise or downside risk for 2021 for economy would be an out-of-control virus spread that requires a stricter lockdown than what we are currently experiencing at the moment, not just domestically as well, because we will also be affected through the global supply chain. And I think that would end my presentation for today. Back to you, Farid. Thank you.
Thanks so much, Khai Jhek. That was really great. I for one personally hope that you're right in that 2021 we will see a much better GDP growth. I'm into that. So let's move on to the next section, which is an outlook on the equity market. if I had a crystal ball, back in 19th of March 2020, I would have sold everything and put it into gloves, and then of course retire at the sweet age of 31. Alas, we do not have a crystal ball, but the closest thing that we do have to a crystal ball is of course Mr. Yeoh Keat Seng and his outlook. So Mr. Yeoh Keat Seng, I mean, requires no introduction. He is literally a legend in this in this industry. He's currently the fund manager for KIC's Incrementum Fund, Kumpulan Sentiasa Cemerlang's Incrementum Fund. He was previously CEO of Private Client Services of CIMB, CEO of the predecessor of Principal Asset Management, CEO of MalaysiaStreet.com, the first VP and head of research for Merrill Lynch, and head of research for Crosby Securities. So we're really looking forward to hear what your thoughts are on the equity markets for 2021. Over to you, Mr. Keat Seng. Thank you.
Thanks, Farid. Good evening. Farid invited me to talk about the outlook for 2021. I volunteered to talk about the second topic, which is the unique intricacies and challenges of the Malaysian market, which I believe we provided some original content, is a topic which I think is befitting of a CFA audience today. Let's move on to the next slide. Next. Let's start with the good news. I think by any measure, 2021 should be a good year. 2020's very strong performance from March 2020, as Farid has mentioned, should spill over into 2021 for a number of reasons, including the V-shaped recovery, the global economy, which is still continuing to gain momentum, continuation of loose monetary and fiscal policies, Asian markets having more legs to go if the lessons of GFC in 2008 were anything to go by. Fourth, goods earnings visibility, and fifth, easing of trade tensions under the new US administration. Of course, the presumption is that the vaccine will come to play this year, will be effectively rolled out, and that there'll be no mass lockdowns prior to herd immunity being reached, as it's been discussed earlier. Next slide. Next. Okay. Any assessment of 2021 always has to refer to what happened during the post-GFC period to look at the lessons that can be learned. And I think there are two key lessons that we can draw from there. First, the accommodative policies that were introduced in 2008 and 2009 took a long number of years to unwind. QE happened in 2008 and 2009, but the taper tantrum, this is the unwinding of QE, did not happen until 4 years later in 2013. Fed rates bottomed up in 2009, 2008 or 2009, but there was no hike until 7 years later in 2015. The second lesson that can be drawn is that China led the global recovery then, and it looks like they also lead the global recovery today. In period between March 2009 and March 2011, Asian markets went up by 94%, ringgit went up by 20%, commodities index went up by 63%. These numbers are not meant to give a prediction of where we will be heading for in terms of these asset classes, but more to give a sense of direction where it could be given the comparable circumstances which I've mentioned earlier. Next. But with a bit of luck, a good year could turn out to be a bull market for Malaysia and the region next year if the initial flow of funds we started to see coming in emerging markets were to turn into a torrent with more momentum of money coming into this region. And four main reasons why we think there should be a lot more funds flow coming into these parts of the world, Asia and emerging markets. First, a return of risk appetite. When risk appetite returns, obviously money will flow away from safe haven assets into asset classes like emerging market equities, cyclicals, small caps, and so on. Second, early days of quantitative easing, in which case there's no yield, no returns for developed markets, and there'll be a lot of search for returns in emerging market and in Asia. Third, sharp recovery in global trade. We've gone through a period of deglobalization where trade has come down quite a bit compared to GDP, global GDP, but this is about to reverse. And because of Asian economies' much greater exposure to trade compared to developed markets, our economy should perform better, earnings should do better, and currency should be stronger as well. And fourth, whenever there's a weakening of the US dollar, money should flow, portfolio hot money, into the asset classes I mentioned earlier. So for all these reasons, I think there's a very good chance we'll see a massive flow of portfolio money into Asian emerging markets this year and possibly spilling over into next year. Next. The next two slides will show you how undervalued emerging markets are compared to developed markets. This one shows you the ratio of price to book of emerging market to developed market, ranging from 0.5 times in 2001 to a high of 1.2 times in the summer in 2020, coming out back to 0.6 plus times today. There is no reason why emerging markets should not trade parity with developed markets in terms of price to book. And parity, there's a long way to go from where we are today. Next. Over the last 11 years since the global financial crisis or GFC, developed markets outperform emerging markets by 70%. And to quote Howard Marks, there is an inevitable cycles in investing. And these cycles tend to reverse over time. So I think it's worth putting money on the bet that the underperformance of the emerging markets will reverse at some point in time. And there's a very good chance it will start this year. Next. So to sum it up, where we are today, we have the end of the pandemic crisis, the reopening of the economy, fiscal monetary stimulus, which leads to a return of risk appetite and hunt for returns. In this kind of scenario, it's no-brainer. There should be a preference for stocks over bonds, commodities and cyclicals over defensives, emerging market equities, bonds and currencies over their developed market counterparts, and small caps over large caps. Next. In any presentation on market outlook, analysts and presenters always have caveats in terms of what could go wrong. This list is quite self-explanatory, so in the interest of time, I won't elaborate on them. Next. We move on to the second part of the presentation, which I'm personally more excited to talk about. And as I said earlier, I believe it incorporates some original thinking, which I've not seen discussed elsewhere before. Next. This chart shows you my pet beef with the Malaysian market. Over the last period of 5 years, 10 years, 15 years, the KLCI has underperformed the GDP, sometimes at very substantial margins. If you look at the last 5 years, the KLCI delivered negative returns. This is before taking account dividend yield, versus 2.7% GDP growth per annum over this period. Last 10 years, almost no growth for KLCI versus 4% for GDP. Similarly, as well for the last 15 years. It's only over the last 20-year period where the KLCI has outperformed the GDP. And it looks like you need a crisis to happen before the KLCI can outperform the GDP, which is quite a shame. Next. Just for comparison's sake, if you insert the bar chart, the orange one shows you the technology sector within the KLCI. Into this chart, it shows you the vast discrepancy of how much tech has outperformed the KLCI and the economy. It doesn't take much imagination to think about, how do you enhance value in the portfolio, either as a personal investor or institutional investor. If you put a bit more tech, by all measures, you should outperform the KLCI and probably other peers who are a bit more beholden, a bit more rigid about straying too much from the KLCI index. Unfortunately for us, the KLCI has zero exposure to tech. Next. The other market challenge. Okay, first we talk about the challenge for the index earlier. Now we can talk about the challenge of the market and then the challenge for the economy. The challenge of the market, first and foremost, is the fact that the Malaysian market today has reached a level of almost irrelevance to international investors. This pie chart over here shows you the allocation of our country weights, and 10.45 refers to others in Asia, mostly comprising ASEAN markets. Malaysia accounts for about 2% from there. A market that accounts for 2% in a portfolio of Asian securities is irrelevant because the fund manager can afford to have zero weighting in this market and yet not risk benchmark tracking error because 2% is just too small difference. I think older investors, some whose names I see in this participants list, will recall a time back in the 90s when Malaysia accounted for 20% of the Asian index. That's when Malaysia is relevant. Today, it's not. But the corollary or the positive side of where we are today is, with such a low weighting of Malaysia in the index, with fund managers, most international fund managers being so underexposed to Malaysia, just a small spillover, a more small flow into emerging markets, into Asia, into Malaysia, can make a whole lot of difference for our market. And this is what we hope will happen this year. Next. This one is quite interesting for me. My personal belief is that the Malaysian equity market has been in bubble territory for the last 10, 20 years or so. And this is due to two reasons. One, the rapid growth in funds managed by GLICs and private sector investments over this period has been largely captive, largely have very low international mobility due to currency controls, meaning they are largely channeled into a local equity market. So what happens when your fund size grows faster than the supply of stocks? The market tends to rate upwards naturally. And this is what's been happening in Malaysia for the last 20 years. Second thing unique about Malaysia is that we have this pool of savings investment schemes that channels these funds into capital market instead of being intermediated through the banking system, which is now in most countries elsewhere. And from these two observations, a number of questions arise on whether this model can be sustainable. One, how much longer can these funds be held captive? Will there be a case of leakage? Will the GRCs feel that Malaysia does not yield you returns and hence they have to put more money in developed markets and other markets? It's already been happening. Two, how much can savings grow without having to tap on investors borrowing money to put their borrowed money into some of these savings funds? This is again happening. And this creates a bit of a risk, imputed risk into the system, on the belief that some of these funds have an implied guaranteed return. If this return is going to be generated for a sustained period of time, the cost to the government and to the economy can be quite substantial. Just to give you a quantifiable example, say we have a fund with $200 billion ringgit worth of assets. Say the funds generate 4% per year, because some of the investors in the funds borrow at a cost of funds of 3 to 4%. So by hook or by crook, the funds will generate 4% per year. And for a period of say 5 years, this fund doesn't generate its return. The government or somehow or other, the fund has to find a way to generate return or to pay a return of 4% per year on 200 billion. That's 8 billion per year times 5 is 40 billion cost on the system. I'm talking about potential contingent cost. We don't know whether it will happen, it won't happen, but it's something that's worrying. And what's more worrying is that some of these funds have not stopped growing. Just imagine, Malaysia has a population of 20 million in theory, which can qualify to put 200,000 each in, say, the ASB. 20 million population on the 200,000 each equals to 4 trillion ringgit worth of funds, of savings money or borrowed money. I dare not imagine if this money, these funds would explode to that kind of size, what kind of cost it could impose on the system. Finally, in terms of distortion, what happens when this money that normally goes to a bank, intermediated the banks into loans, today goes to a capital market? Implications is cost of borrowings for the banks has gone up because the savings that's supposed to go there instead went to the capital market. The cost of funding for capital market has come down. So there's a distortion to the system. As more of these persists, there will ultimately be a price to pay on both the capital market and banking system side. I will talk about this a bit more later. Next. Challenges to the economy, I won't over-elaborate because you read this, countless times in all the media, papers, and economists and so on. And the key point to note is that our economy has not changed much since the global financial crisis. Over reliance on oil, low R&D, low productivity. Our economic structure today does not constrain the limits we face in terms of growing, rising wage costs, worker shortages, and so on and so forth. I'll skip on and move to the next slide. Finally, moving on to my last two slides on a food for thought. 3 points to make. Next. There have been many times when fund managers like myself look at the pathetic KLCF performance and wonder, Why doesn't this bloody index give a better return like the S&P and the Dow to give us a better base of performing? And that struck me to try and understand why is it that KI doesn't generate returns? And this is the first time I attempted to dissect what the components of the KLCI in terms of what they represent for us as investors. First and foremost, the KLCI does represent the overall capital market, equities market in Malaysia. The capitalization of KLCI is about 59% of Malaysia's, which I think is quite fair. On the other hand, the KLCI represents GLCs because 55% of KLCI market capitalization are GLC companies. The KLCI represents whole economy companies, ex-growth companies, high disruption risk companies. To me, I categorize banks, plantations, power, oil and gas in this section. Tech and high growth sector, zero exposure, as I mentioned earlier. Region exposure, 10% or more of the stocks, half the component stocks have more than 10% exposure to international operations exports. I see this as a big plus because Malaysia is too small a market. And in order to grow on a secular trend for 3, 5, 10, 20 years, you need to address a global market and not a Malaysian market. And it's no coincidence that some of the best performing stocks in Malaysia, like your Vitrox, your Top Glove, QL, Dialog, and so on, all address the international demand and not just Malaysian demand. So that's a slight plus. But let me just address a bit more this issue of disruption. Tenaga today has something like 6,000 megawatts of capacity. We all read about renewable energy, wind, solar, batteries replacing traditional fossil fuel within a matter of 10 to 20 years. You want to guess what's exposure of Tenaga to renewable energy? 0.5%. Tenaga's market cap today is about 57 billion, 8% of KLCI. Imagine 10, 20 years from now, Tenaga's share of the total generation capacity goes from maybe 80% today to 5, 10, 15, 20%. What's going to happen to Tenaga's earnings, market cap, and KLCI representation? The fact of the matter is, the more we have of this kind of sectors and stocks that are subject to disruption, have very little growth, the more the KLCI cannot perform. Next. The other very, very unique issue for the Malaysian market is we have this dominance of GLICs, sorry. GLICs account for a cumulative 1.5 trillion ringgit of assets under management, or 75% of the total Malaysian assets under management. And GLICs have this incestuous relationship with the market. GLICs manage funds, they invest in GLCs, controlled by GLICs themselves or other GLICs. Is this sustainable or ideal? Not quite sure. Third point, the KLCI is not designed for growth and has not rewarded risk. Smaller funds have been able to constantly outperform by putting a bit of tech, as I mentioned, for example, deviating away from the KLCI, investing in other smaller cap stocks or non-KLCI stocks that can do better, or stocks that address the global market, as I mentioned earlier, rather than those who invest largely in old economy and non-growth sectors. But can the ultra large funds who by default invest in the KLCI themselves have this flexibility? Can KLCI tracker funds or ETFs be viable when there's been no growth for the last 5 years, very little growth for the last 10 to 15 years underperforming KLCI? The other newer category of tracker funds, smart beta ETFs, as some people call it, I think will suit the purpose better. I think some of the local fund houses have been ahead of the curve, have introduced these things. This is what I will invest in if I will invest in tracker funds in Malaysia and not just KLCI. Finally, should multi-asset class managers review their commonly high allocation equities, given that the adjusted return for equities has been very low over this last 5, 10, 15 years compared to other asset classes. I've chosen to end this discussion on an open-ended basis rather than on a prescriptive basis, hoping that maybe someone at Faridq or the CFA Society of Malaysia will pursue some of these discussions and come with some recommendations or suggestions that will do a service for all of us who invest in Malaysia. On this note, I'll end my presentation here. Thank you.
Thank you so much, Keat Seng. Yes, definitely. I think that's also part of the drive for this year, where we can come up with some thought leadership, just to sort of put our thoughts out there and just try and see how we can enact some form of change, as you mentioned earlier on. So thank you so much for the amazing presentation. I see a lot of questions already coming in directed to yourself. But before we go into that, let's go into the next session. The outlook on the fixed income market, which will be delivered by Mr. Teng Yeoh Xiang. So Yeoh Xiang is no stranger to the CFA webinars. He's a very well recognized face here for our webinars. He's currently a fixed income portfolio manager with Principal Asset Management, and he's won several asset management awards, including Lipper and Morningstar. So we're definitely talking to a winner's circle, manager in the winner's circle over here. Yeah. So over on to you, Mr. Yeoh Xiang. Thank you.
Hi, good evening, and thanks, Faridq, for the kind introduction. So from the very beginning, when we saw the poll results, right, well, bonds, be it in developed market or emerging market, had the least kind of like percentage. So I'm just going to keep this presentation fairly short. But maybe from my presentation, you may want to change your mind as well. So with that, I'll start with the first slide on walking down the memory lane, if you will, of what happened in 2020. That you can actually see that the great majority of the fixed income market deliver fairly strong returns. So if you look at the left-hand side of the table, right, that represents the very well-known FTSE World Global Bond Index performance broken down into different constituents, right? So you can look at them, right? They have both local currency return and dollar currency. It translated into a dollar unhedged return, right? Easily, a big majority of them deliver double-digit returns in an unhedged term. So, and if you look closely into that, right, like for example, in areas in the Europe region. So going into 2020, one of the biggest themes that we saw was negative yielding assets amounting up to $1 trillion. We're talking about countries in the Europe regions, mostly the core European regions, like the likes like Germany, the likes like France. So a negative yielding assets deliver a positive return, and translating on an unhedged basis, it translates into a double-digit return. So that shows that that because of course it's all driven by the pandemic and everyone poured their money into safe haven assets. So this kind of performance, right, as you all know, fixed income has sort of like a finite returns over a period of time. So a strong return in last year may translate into a more normalized return in the years ahead, right? So if you can look at the table on the right-hand side, for example, those are the more emerging market numbers. If you look at the table on the top, for example, in the more Asia concentrated regions, right, you can see that some of the high yields market, for example, in Sri Lanka, for example, in Indonesia, they deliver about 20%, 15 in the teens to the 20% of return. But at the same time, if you look at countries which traditionally has been in the low yield market, like Thailand, Thailand's bond yield today is lower than Thailand's bond yield in Thai baht today is lower than US Treasury. So those kind of like low yield kind of set a tone what kind of returns it will be delivered in the years ahead. So that's why I put my slide header as down to the last leg. If we are not already at the bottom of a rate cycle, we are damn near to that. Next slide. All right, so most of the fixed income asset classes, right, we tend to start from the global side of things, which is the G3 markets. So as we are aware that, what happened in the US states is that the Georgia runs off. We finally saw a sign that, both the House and the Congress will be, both the Senate and also the House will be won by the Democrats. And that will make the stimulus spending a lot easier. So we're expecting close to about $1 trillion of spending package to be passed in the next few months. So how would that play in the treasury market? In the sense is that the higher stimulus will always translate into a bigger deficit and will translate into a higher treasury supply. So taking into the market movement that we have seen for the last 13 days, or rather since the beginning of the US election in end of November or the beginning of end of October or beginning of November, right? You saw the treasury yields have already steepened on the long end. And of course, there is expectation of the gradual rollout of vaccine across the world, but of course, it will be made faster in the more advanced economies like Europe, like US and Japan, right? You have started to see their yields to revert higher. The table on the bottom, which is essentially the average 10-year yield of the G3 markets, have already inched up to a positive territory from a negative territory at the beginning of the end of the year. So, similar theme will still carry out in those markets, but they will still pretty much remain as a negative yielding markets, especially in Europe, because of the willingness and the capacity of the central banks over there to keep it low. But suffice to say, our base case is that growth will carry out throughout the year, and even those markets may see their yield steepen by the second half of the year. So this year is going to be a year of two halves, where the second half of the year is where we have to start to think about the steepening happening throughout the world. Next. Now, back home in Asia, so the outlook for 2021, it's also brighter. We definitely have a stronger fundamental in Asia compared to the rest of the sort of like a emerging market region. So a table at the bottom show you that the default rates across all the emerging market regions in Asia, in EM Europe, in Latin America, and also in Middle East, right? Historically speaking, Asia has always been one of the lowest default rates. This year, last year it almost doubled from 2019 to 3.6%. That is made worse by the onshore default of the SOE enterprises in China. So China has also learned their lessons to selectively build out SOE. They are in better management, and that kind of like attitudes in treating the capital market as a whole, right, is actually quite welcoming for the emerging market investors, because now bottom-up selection actually makes sense. Before that, right, you can just buy into any China SOE and hope that if anything goes wrong, the Chinese government will be there to help. But that's not the case anymore. So I saw one of the questions put in the poll is that the credit spreads in both the in the investment grade and high yield has contracted a lot, and you can clearly see that from the table on the top, especially on the right hand side. So that represents the average credit spreads for the very well-known Jackie index. A very well-known Jackie index was followed by the emerging market bond investors. Yes, it spiked to close to about 400 basis points at the peak of COVID-19. That's mainly because the index were very skewed towards China. I think about 40% of the index, or maybe slightly below that, is China-centric, and that's where the pandemic started. But of course, we saw how the Chinese response to the pandemic was, and very quickly that they have shut down cities, they control movements, and I think in a way that we have to really say that China really stood as one of the countries who has a much better control in COVID compared to other emerging market countries. So in that sense, right, you started to see the earnings and cash flow in Asia corporate to turn around in third quarter. So if you continue the rhetorics of end of 2019, where growth is resuming, I think the credit spreads now is not too tight. It's just back to where it was before. But of course, we could still be wrong in the sense that maybe COVID is still not over yet. So then again, right, bottom-up selection becomes an even more important kind of like investment process for most of the investors out there. Next. All right, so again, closer to home, I think what we want to address over here is that there is clearly a big elephant in the room here, which is essentially our sovereign rating in the Malaysian bond market. And I sort of like want to answer the questions, or maybe the other panelists want to chip in as well, on the likelihood of further downgrades by any. Well, Fitch has already made their first move, so the remaining ones will be S&P and Moody's. Whether they will downgrade us to a BBB plus country or not. Because if any of them were to do any actions, right, then our median rating will be in the BBB plus territory, very similar to Thailand. So if you look back at the reasons why S&P put us on negative outlook, right? In addition to the fiscal deficit that is ballooning up, we have already passed, in the parliament that we raised our debt ceiling to 60%. But personally, I believe that this number will revise higher again, even if we are very successfully in controlling the COVID cases, right? The GDP growth is unlikely to catch up so fast that we can reduce our debt. So 60 might go higher to 61 or 62 in the years ahead, and it will probably peak at around 63 to 64% in 2023. So that actually gives some reasons for S&P to further downgrade it again, and also not to mention that the political scenario in those markets. But again, even if the rating agency, S&P, the most likely candidate, were to downgrade us to BBB+, right? I think this is the part where I also want to talk about the captive nature of the MGS market, just like what Keat Seng said about before, right? Like EPF and the pension funds are the biggest investors in this market. And because of the currency control that's being implemented or by the central bank that's still unlifted since 2016, right? So it becomes a very captive market in the sense that it is a time where the country needed that the most. And we can definitely see the strong support coming from institutions to make sure that the bond yield, it's not going to be too crazy high for the years to come, for the months to come, if let's say a rating agencies will downgrade. And also, domestic economy is still quite resilient in the sense that this round, like what Khai Jhek has spoken about, the difference between the MCO in this time around and last year, right? Most of the economies, other than a handful of them, are not able to operate. So in terms of cash flow generations, in terms of economic activities, it will still be slightly better than last year. So I think even if it were to happen on the downgrade, right, Malaysia bond market will still be able to absorb the volatility, as we have seen it year and year before. There will be one slide that talk about the performance of the government bond market or the performance of the bond market in Malaysia for the last 3 years. You don't see a very sharp drawdown. Even if there's a dip, right, it wouldn't last for long. Next. Now, of course, rating is definitely one elephant. It turned out that we may have another elephant in the room here, in the sense that our supply of government bond this year, it's going to be quite high as well, even higher than last year. So last year, we ended the year at around about 150 billion of gross supply, mainly because of the all the Prihatin packages that we have seen, we have talked about in the past webinar, right? So this year, we are still continuing to see the bond supply to be high, mainly because the continuous rollout of stimulus that's carried out by the Ministry of Finance from last year. So the question is, can the Malaysian bond market absorb all this supply, especially with news like EPF is going to have some ICNA program that will face some cash flow issues. Again, I think the supply issues, it's not a very big concern. Definitely the risk has increased. And in fact, if I can show you on the next slide, maybe later, on where the yield curve of the Malaysian government bond yield is, right? A lot of negativity has already been priced in since the second half of the year. The more stimulus that's being announced by the Prime Minister and also from Finance Minister, right? The bond market has already adjusted itself, right? So if you recall back on the first slides when we talk about regional performance, right? Malaysia bond market, it actually did not perform better compared to our regional bond market, mainly because of the concern. So in 2021, we are going into the year with all these risks being priced in. And there is still a silver lining that it may not turn out as bad as what we think now. Of course, everyone's at the back of everyone's mind is the MCO 2.0 and also the state of emergency, right? In a way, I think that this will actually bring about stabilities in the political space, which is also another factor where rating agency is measuring when it comes to the sovereign outlook. So long and short, Bank Negara will still maintain both the liquidity and also the interest rate market to be very accommodative. And from the point of diversifications from risky assets, I think there will still be some support in the government bonds market. So I'm not too concerned about this current supply, but of course, Yesterday, Tengku Zafrul, the finance minister, has hinted about further stimulus. That one could come out as a surprise. Could come out as a surprise in the sense that we may see even higher supply, and that becomes a new dynamic for us to think about whether yield curve has to be adjusted steeper again or not. Next slide. Okay, so I also want to talk about the credit market in Malaysia. So this table is basically 13 years of return in the Malaysia bond market, spanning out from the global financial crisis time until currently. And you can look at how the yield and the performance of the market has been over the time. So over the last 13 years, right, corporate bond has outperformed government bond by 9-4. But very weirdly, in 2019 and 2020, corporate bond has underperformed consecutively, right, 19 and 2020. So in 2019, the rate cut was only 25 basis points, but the backdrop was the negative yield in the developed market that has driven flows into the emerging market. So in that year, right, although the delivery of OPR action was only 25 basis points, market was way ahead of itself to think about, more rate cut and more rate cut and more rate cut. Bank Negara's stance back then was, 25 was really sufficient. In a way, it was good that they did not over-deliver in 2019 because that would translate into less ammunitions for them to respond to the crisis this year. So with rates already at the current level that we have not seen since, even in the global financial crisis, we did not bring ourselves down to this kind of yield level, both government bond and corporate bonds. So if a fixed income investor have to stay invested in the ringgit bond market, where should they be putting their money in 2021? Our bet is that it will be in the corporate bond market because there is still some credit spreads pick up, and because in a way, corporate bond market is more defensive compared to the volatile nature of MGS. If Malaysia can also mimic the rhetorics from the global market where second half of the year is actually a better year, right? We can actually afford to see credit spreads to go tighter. Well, govies will definitely be anchored here or even steeper if, let's say, or actually, Malaysia case will be a little bit different. Our steepness now is to account for the low growth and also the high fiscal deficit. If, let's say, things were to turn better for Malaysia, right, we can actually see the long end yield to come down. It's very different compared to the developed market because, we have a very different fundamental now. Next. Okay, the last 4 points that I want to talk about in the ringgit fixed income market is very simple. Number one, I'm going to pick Khai Jhek's buzzword on the uneven recovery. So both, we have seen the economists from IMF and also see our domestic Bank Negara government talk about the unevenness in terms of the local economic recovery. So we are still at the very infancy of recovery, and we are not even in the recovery yet. We are just hoping that recovery will happen. So if you think that you still want to remain some kind of like defensiveness in this very early stage of recovery, you should still look into fixed income market, because on the chart on top right, it shows you that the Malaysia bond market, it's a lot more resilience compared to our equity market. But of course, from Keat Seng slides earlier, right, it doesn't really represent the KLCR doesn't really represent the economy, but the bond market in a way has more diversification compared to the equity market. So that shows you that the the SME sector, the companies which are not listed but are in the bond market space, right, they are actually stronger than some of the blue chip companies in the stock market. So the low volatility and also the sort of like a respectable return is something that will continue to play out even though in this kind of market. The next one is talk about the steepness in the Malaysian bond yield, which like I say, last year we cut about 125 basis point of rate cut. The movement can only be felt on the front end of the yield curve, right? We all know that the short end of the yield curve is always more closely related to the policy rate. And the long end of the yield curve reflects on your economics and also your inflation expectation, right? So ever since the market started to think about the stimulus that's needed in this country and also where our debt ceiling is and the likelihood of us pushing it further, right, the long end yield curve has already pushed up much higher. So in terms of valuation, the long end is very, very attractive. But it's again, it could be a value trap in the short term if our growth does not pick up. You know, some of the research charts are citing that if MCO 2.0 were to prolong, it will be a drag in the growth again, which translates into higher stimulus. If that's the scenario that we have to live in, then the long end yield curve, it's already there and it's very hard to move downwards. But if let's say we just have a little bit of optimism, hope in the successful control of COVID, then there is a lot of benefit to be reaped on the long end of the curve. And lastly, some of you may be coming from the corporate space where you are restricted in the amount of investment activities that you can take for your company's reserve. So if you look into the deposit rates that's offered by most of the major banks in Malaysia, right, it's actually quite disappointing in the sense that we never seen this kind of FD rates before. So diversification into bond market may not be a bad idea, especially to an asset management company house that has got long-lasting track record, right? Because it will still be able to provide you some kind of yield pickup against your FD rates, and the liquidity is actually still there in this market. So with that, I'll wrap up my presentation for the ringgit fixed income market, and back to you, Faridq.
Thank you so much, Yeoh. So I think in general, Yeoh is really talking about Malaysia fixed income as more like a volatility dampener and more of a hedge against uneven economic recovery, somewhere along those lines. Am I right, Yeoh? Somewhere along there.
Yeah, absolutely. Even again, we back to CFA. One of the things that we learn is about diversification. So yes, depending on your risk tolerance and depending on the nature of your work, right? For example, like I said earlier, a lot of companies, they already take on business risks, and for the excess capacity in their treasury coffer, they may want to look into something that is, generally speaking, higher yield compared to their fixed deposit and less volatility. Then they should be looking into the fixed income market in Malaysia. Yeah, not to mention also the tax benefit. All right.
All right, thank you so much, Yeoh. Okay, so so we have come to the Q&A portion of the session. Before we go into there, if I could just sum up or summarize really quickly on the gist, if hopefully I didn't butcher anyone's key takeaways, but if I could just summarize everyone's thoughts, I would say that we can sort of call it the 3 R's. The first R being recovery. Yeah, that seems to be the consensus view here, that 2021 will be a year of recovery, although as Khai Jhek said, it could be a little uneven. It's also looking towards a year where rates seem to be playing such a key and important role, not only in terms of its impact to fixed income, but also in equity multiples. And the last one, if I'm not mistaken, it would probably be an outlook of a reflation. Yeah, so some sort of a return of inflation, so to say, if I understood it correctly. So those are my sort of quick wrap up, and let's just jump into the questions. Yeah, and feel free, everybody, to continue to submit questions. We have about 15 minutes for the Q&A session. The number one question, of course, is directed to Keat Seng. Do you think retail investors will continue to dominate the stock market as they did in 2020? And how will this change the characteristics of how the stock market will perform?
I think based on my experience, retail investors are not evergreen investors, or they don't have a permanent presence in the market to the same form, in the same quantum, to the same substance. So I would say they are more seasoned investors. As long as the market is good, they'll be there. But if there were to be a correction in the second half of the year, the next 1 or 2 years, then you'll see their participation diminish over time, almost certainly. That would be based on my experience.
Yeah. And also, if I can add to that, 2020, I think, was a very strange year, because usually retail participation is used as an indicator to get out of the market rather than to go in, right? But in 2020, what we saw was that the market was led by retailers, followed by institutional investors, which I think was rather strange in a way. The second question let me just direct that to Khai Jhek. Do you foresee an OPR cut this year? Maybe this can be open to Khai Jhek and say Yeoh Keat. Do you foresee an OPR cut this year if MCO is extended?
So maybe I'll start first. So I think basically it is still fairly, I guess, open-ended at the moment. Because I think as I mentioned in the presentation, generally, I mean, we do expect quite a big, or at least quite a notable dent towards the ongoing recovery momentum. However, we will also know that the MCO 2.0 is not likely as tight as MCO 1.0. So generally, I guess the MCO 2.0 has a high emphasis on ensuring the economic activity actually operate with minimal disruption as possible. So if Bank Negara actually feels that the tightening restrictions might not actually be severe enough to prompt actually an OPR cut, so this might not actually happen. So I think at the moment Bank Negara might still take a more wait and see approach, and maybe, like you say, save the ammunition for even severe deterioration further down the road, like if it actually materializes. So perhaps they might actually take that the 175 basis point cut that they engaged in 2020 might actually be enough to actually, I guess, support or in a way be more accommodative to whatever challenges that may arise from the MCO 2.0. So, and perhaps we can actually see further down the road if more hard data is actually out, whether is it actually an appropriate move or not. And I guess for now, I would just say that I would lean towards them maybe saving information for anything serious that will happen in the future. Yeah.
Yeoh Keat, do you share the same view?
All right. I think the question is actually two-part. It's whether the OPR will cut this year if the MCO is extended. So I also want to take the opportunity to say that there are actually one coming meeting just 1 week from now. The first meeting of MPC, the Monetary Policy Committee meeting, is on the 20th of January, and that time we are still in MCO. So we can't say, okay, maybe we have a better picture by then whether MCO will be extended or not. But personally, I think the governor has time and time again in last year talked about that there are only so much that monetary policy can help in terms of reviving the economy, right? So rates have already been slashed by 1.25% last year and 25 basis points in 2019. So I think everyone can feel the benefits of paying lower mortgage, and that the same rhetoric can also be seen in the corporate space where they're paying lower cash flows in terms of the interest serving. But the bigger problem that we are facing here is the dampening of demand, or the lack of economic activities in the entire country. So that alone, right, cannot be helped by monetary policy. So I think on the 20th of Jan, I assign maybe 40% of likelihood of OPR being cut, but I think the language will turn dovish compared to a more neutral. Dovish basically means that there's a hinting of probably more easing in days ahead, right? Compared to their November statement of the more neutral kind of tone. And also I want to talk about how market will react to it. In fact, market has already reacted to this kind of rhetorics today. We saw the short end of the market move down by about 12 basis points already, up to tenors up to 5 years. So market is already moved towards that, like half. If you think that every rate cut is about 25 basis points, right? We are already halfway there today. All right, we are already halfway there today. But the long end of the yield curve didn't even budge, because we know that more work needs to be done by the fiscal side of things, and more fiscal spending means more supply means steepness of the curve. So I don't think the likelihood is high in January meeting. And when it comes to the March meeting, which is on the 4th of March, by then, right, the rollout of vaccine should have already started, if it's not in Malaysia, in some part of the world, right? And the expectation of growth to resume will be even stronger by then. So I don't think much will also be, if base case were to matter, right? If we can control COVID, even though MCO is extended, perhaps not too much, another 2 weeks or so, by then we should already start to feel that, the economy is coming back again. So I don't think March will be a time where they will cut rate as well. So both the short-term MPC are assigned a low probability of rate cuts, less than 50%.
Okay. So lower probability of both in the January and the March meeting of any change, right? Of any change.
Also, just to add on to what Xiang was saying, actually, I think Bank Negara also acknowledged in the past that the OPR cut is a relatively blunt tool in terms of monetary stimulus, especially under the current COVID situation. Given that we know that the MPO actually disproportionately affects those in the lower income as well as those in the smaller SMEs, micro enterprises. So the potential come from OPR cut to these vulnerable groups might not be as positive as they would like it to happen. So perhaps a more targeted approach or a bit more directed kind of fiscal pump might be more appropriate as a form of stimulus rather than OPR cut. If you want to, support the general notion that January cut might not actually happen or even a March cut might not happen.
Yeah, can we build on that point where you talk, and this is also I see the general consensus across, right, that there's going to be, or at least there's expected to be large stimulus package being rolled out. But but as we know, last year they already rolled out that $250 billion mitigation sort of stimulus package. That's about 70% of GDP. And then Yeoh Keat Seng, in his ending remarks, he also talked about expectations of the finance minister announcing another round of fiscal stimulus. So my real question here is in terms of indebtedness, right? How much more room does the government have to and whether can it afford more of these stimulus packages? And do you think there will be any impact down the road, say maybe an increase in tax to pay back that and so on and so forth? What do you guys think?
I think it's quite likely that we will see the debt to GDP to grow higher. Like I said earlier, right? Even if you to expect a growth rate to back to, let's say, this year it's going to be high, right? We talk about potentially up to 6-7% of growth. But we saw the number, the jump in debt was much higher compared to that. And I don't think this momentum will slow down because it's very simple. The next couple of years of debt maturity profile from our country is amounting to about 80-90 billion per year. So that's the amount of debt they have to roll over for the next 3 years every year. The room for them to cut down on debt is very limited now. So let's in our base case assumption, we will think that the debt ceiling will go higher from here, and the parliament have to again pass on some legislation to bring it higher, and that's just something that bond investors have to be contended with, and also to price in the risk of that happening. But like I say again, the long end yield curve in Malaysia, it's already one of the cheapest across Southeast Asia because of this risk characteristics. Whether it will go higher or not, it depends on how strong of discipline of the government is to bring down those fiscal deficit and what are the methods. Like you say, tax, definitely, we may see that coming to haunt us again. But it depends on what format, right? So just like the rest of the country, the rest of the world as well, we can expect maybe not this year, maybe in 2022, where US may also start to raise tax again. We have a more democratic kind of very different from the last administrations where they just want to cut corporate tax. This time around, tax may be coming back again, and that will be a theme for 2022 and above.
Yeah, can I just sneak in a question a bit more, how do I say, a bit more recent developments to the whole panel? Has your strategy changed because of the emergency order? Has that announcement in any way changed your strategy for the year or in terms of sectors?
I think this question is open to both sides of the asset classes, right?
Correct. It's open to all. To maybe you can even to Woon Khai Jhek. Does it change your your growth forecast for the year, for example, up, higher or lower? Maybe we can start with say, why don't we start with Keat Seng? What do you think about the? Does it change your strategy in any way?
I think the strange thing about market sentiment is the market could look at the same development and view it very positively as being, say, a cup half full when sentiment is very bullish, and the same development in a different environment view it very negatively. So if you notice the KLCI market's behavior in the last couple of days, there was actually not much of correction, and there's a very sharp recovery this year for most of the stocks we follow. Largely because I believe people are looking beyond this MCO, which they think will be over a finite period of time, 2, 4, maybe 6 weeks. And with a vaccine in the pipeline or somewhere out there, we should be able to tide over this period. And this is not unique to Malaysia, because even the US, there were initially some concerns over the Democrats controlling the White House and both houses of Congress. But because sentiment was so positive and because of the small majority, the market took the winning vote in Georgia very well, and there was no correction at all for the market whatsoever. So I would say we wanted to take some profit in the last couple of days, but looking at how the market sentiment has been, we pulled back our sell orders.
So if let's say I'm a fixed income investor where I can only invest in the ringgit fixed income market, right? I think my strategy remains the same. We generally do not see much very strong capital returns from the government bond side, mainly because we don't really think that there's much room for Bank Negara to cut. And also the cutting may actually not help much in terms of the bond yield movement. You only benefit very much on the very short end, the 1 year, 2 year, 3 year bonds, which generally speaking, their duration is low. Their potential capital gain is also low. So it's not going to help much. But if you look at the credit market, increasingly we saw more diversified issuances coming up from this Malaysia corporate bond, right? We can now see, for example, I'm not going to say name, like we saw some very strong retail names are coming out to issue bonds. We saw some auto manufacturers, which has traditionally been a client of the banking system, coming up to issue bonds to take advantage of the low rates and also of the much bigger investor base, right? So those are names that we can diversify to, and that makes credit selection a very important key aspect for 2021 alpha delivery. So you want to really strengthen your credit discipline in looking into companies where either they have transformed into more adaptive to whatever that's happening now, or their cash flow visibility is still strong in the short to medium term. And some companies which have been a fallen angel, maybe in 2020 they have fallen by too much that they started to look attractive again, right? Especially we're talking about the airlines or the airports. Those can be very good trade ideas. If let's say the rhetoric is really things gets better, then you can look into those kind of like investment ideas to generate extra return. Again, with low yields, you really have to think out of the box how to get the extra return. And also, not to mention, our Malaysia unrated market is actually getting bigger by the day. And to the extent that some of the institutional clients and institutional investors are also looking into this market. This represents an even bigger part of the Malaysian economy. We're talking about sendirian berhad nature kind of like issuances. But of course, you have to be contented with their low liquidity and low tradability in the secondary market. But it's something that if you have a strong credit team, that's benefit that you can reap.
So you're seeing more of them having more risk appetite for these kinds of names. You're seeing them being pushed towards, I would say, more illiquid names. Am I right? Is that what you're trying to say?
You are generally trading liquidity for risk premium, which depending on how strong of your credit capacity is, you can really have the cake and eat it in a way.
Yes. Okay, so we are actually kind of running out of time here. So I'll just pick the last question out of the bag, and I think this is really a fantastic question, I would say. On the surface, it seems like it's rather direct, which is, do you expect Bitcoin to sustain momentum going forward? But I try and interpret this into thinking more about alternative assets. You see, there's growing interest into more alternative assets, into more risk taking, and so on and so forth. So I am seeing I am personally seeing a lot of parallels with previous, booms and of course busts, such as, in the 2000 tech bubble, for example. Before 08, in 07, everything looked like it was going to go to the sky. And then today, not only are we seeing Bitcoin going up, then we're seeing, new issuances of SPACs. I mean, if you don't hold Tesla, forget about outperforming if you're an international fund manager. So in your experience, maybe we can start off with Keat Seng. Since you have been through a few of these boom and bust sort of cycles, what do you think about the situation at this point in time? Are we in bubble territory, or are we still safe and it is prudent to take on more risk at this point in time?
If we talk about valuation of most markets in the world using the traditional PE basis of valuing stocks, price to book, it will appear that most stocks in the world are in bubble territory because the prices have run far ahead of the improvement in fundamentals. But there has been counter arguments to say maybe valuation should not be just based on PE or traditional price to book, largely because a lot of things have changed. The cost of capital, cost of debt has changed a lot compared to previous cycles. Two, the risk premium today is much, much lower than it was maybe 1, 2, 3, 4, 5 years ago. So that should be imputed in the pricing as well. Three, PE tends to value stocks based on 1, 2 year earnings valuations. But if you believe that we are in a good growth cycle for the next 3, 4, 5 years, then the market can sustain 1 or 2 years on a higher PE valuation basis. That's speaking in general about equities across different geographies generally. But on specific asset classes like maybe Bitcoin, cryptocurrency, SPACs, it's not in my realm of coverage, but as an observer from a distance, I would tend to think they probably are in bubble territory because there's no ability or basis to value any of this stuff. A lot is based on hope. For example, we invest in gold, so I know what's a typical or historical correlation between gold and different asset classes. Who knows the correlation of Bitcoin with anything in this world?
Exactly. Yeah. All right. So with that, let's wrap it up with the poll. Can we just shoot out the poll really quickly, just to see if there has been any change in expectations amongst our audience? So just to recap, the results of the first poll. So COVID-19 was the overwhelming winner. And that's why most of our audience think will be the dominant theme for 2021. For the asset class that they expect to outperform over the year, the majority voted for emerging market equities, and technology was the sector that they were rather bullish on. So let's have a look at the results of the poll and see whether that has changed or whether that has remained the same. Okay, so COVID-19, 50%. It was 58% before. Emerging market equities actually saw a far larger increase in conviction amongst the audience. That's very, very interesting. And technology also saw a huge jump in terms of conviction. And that's where most of us think will outperform in 2021. Okay, so with that, thank you so much to our three panelists for today. Keat Seng, Khai Jhek, Xiang, thank you so much for sharing with us your thoughts. And to all those who have tuned in, we say happy trading for the year. All right, thank you guys.
Thank you.
Thank you.